Hello and welcome to Nirmal Bang, ladies and gentlemen. I'm Hiral Dadia. We have with us Harihar Krishnamoorthy, Treasurer and Head for Global Markets, FirstRand Bank, joining in. Welcome to the show, Harihar, and always a pleasure to speak to you. Harihar, my first question coming to you is uh, overall, the kind of gyrations that we are seeing with regards to the currency market, a lot to do with it is around what's happening with the global markets right now. Secondly, how the RBI is going to react to the current situation that we are in as well. So, what would your stance be with regards to the liquidity outcome, the interest rate cycles, and globally, how do you expect the central banks to react?
I think that's an all-encompassing question, if I
Yeah.
must say. So, uh, so I think let's go, briefly, but into the factors that you mentioned. One is the global situation. I think globally, clearly, last year versus this year, there's a sea change. Last year it was gloom and doom. Now most of the economies are seeing recoveries happening. Not already on the ground, they are seeing it happening in a very more confident way. So if you go to the biggest benchmark, which is the US of A, you are seeing a very high level of confidence that the economic growth is going to be well and truly there. And therefore, the Federal Reserve is willing to ignore even a 5% CPI uptick because they are very clear that the growth is there on the ground, as can be seen by various parameters like housing and employment and etc. But they also are looking at the rear view mirror and saying, while the vaccination has taken place in a very strong way, you also seeing 1 month back a 14,000 per day click becoming a 80,000 per day click happening in terms of new COVID cases. So the breakthrough infections are still continuing to happen, though the fatality rate has collapsed, and that is probably the comfort that the vaccination brings it. So central banks globally are seeing both a recovery happening, but the confidence level that the recovery is going to be sure shot probably is still lacking. And that's in the last 3 days, you've seen the ECB say so, the Federal Reserve say so. And this week is a critical week. We're going to see the FOMC again come out with its statement. And most of us believe that they're going to say the same thing, that we're seeing good recovery on the ground, but are we sure that it's not going to be kind of toppled over by a sudden surge in COVID and consequences thereof? Not so sure. So we'll keep the interest rates low. So what is happening in this situation is a currency rates wise, money has started moving up back to the developed markets. So you see the dollar index going back from the sub 90 levels to the 92, 93 levels. So it's straddling the 93 odd levels. So by definition, what's happened is all the emerging market currencies, all the currency which are traded vis-a-vis the dollar, have started weakening. Now, it also happens to be on a commodity basis, X the metal commodity. So if you look at gold has come down to that 1800 level per troy ounce, down to 1700 also. So do we see this currency trend continuing? Clearly, yes. I think the dollar index will continue to remain strong as more confidence comes into the US economy in the main, and all DM will look very strong, and therefore EMs will look relatively weaker. Translation also is that the FII flows into the country, which already were weak last year. You saw the FIs being net negative on the debt market and positive on the equity market, almost flattening out between the two. This year, we see the same situation happening. The equity markets continue to remain attractive enough for the FIs, though at every level it looks too richly valued, but you still have the IPOs and things happening which make it attractive enough, but the debt markets will remain unattractive. So the rupee will trade with a weak range, and you already have seen the rupee breach the 74, and the region in the 74, 40, 50 has been its comfort level. Do we think it'll go to 75? It can go to 75, but I think it's in terms of weakening, it's probably come to the maximum level of weakening, and there the reasons are the old ones, but in a stronger way. The reserves were always a strong point for India, but at 630 odd $billion, it's super strong. So if we want to, we can easily handle any rupee weakness. But the idea must be that let's not handle the rupee weakness. Let's keep the volatility low. But if the rupee is weak, it gives the exporters some strength to handle the global marketplace. And the imports, on the other hand, if they get dissuaded, it's fine. And if you look at oil as one of the key parts of the whole process in terms of how it impacts the rupee in the main, and inflation secondarily, you see both the things happening. Oil internationally is say 73, 75, $79 per barrel, but India has been importing lesser and lesser quantities of oil. So in the old parlance or old formula, you would have said that when the dollar goes to and the oil goes to $75 per barrel, the Indian current account deficit will worsen by so many billions of dollars per month. But today, you and I are buying cars, but to travel shorter distances and travel lesser number of days in a week. And therefore, luckily, the amount of fuel that we're buying is much less. So the current account deficit is kind of under control. In good months, it's about $7-8 billion. In bad months, it's about $12 billion. And qualitatively, we are not seeing much of oil getting imported, and qualitatively also seeing not much of gold getting imported.
Correct.
So I think you are in a situation where rupee will be weak. It'll go to 75, but exporters should come in at that particular level. And as far as interest rates are concerned, I think most central banks will hold their gun, wait for more confirmation that the economic recovery is a bit more stronger, more sure-footed, will not backtrack, and then probably announce rate hikes, which probably they're lagging the markets, but they would rather lag the markets than probably throttle a recovery, which is just about happening.
Right. So let's break this up, Harihar. Overall, you know, clearly the yields in the US have been on a downward trend since the last FOMC meeting that happened in the month of June. Uh, However, we did see benchmark 10-year notes, which rose as high as almost 1.77 in March, and then it came down to as low as almost 1.128 in the month of February. And with this, the yield curve has also flattened since then, wherein the gap between the 2-year and the 10-year notes have been shrinking. Uh, Taking all of this into consideration, how do you expect, what's going to happen from here on? Do you think there is a possibility that the treasury market in the US probably could get a reality check from the Federal Reserve following a plunge in interest rates that actually bucked up expectations of higher yields?
In the last 3 months, actually, all the points that you mentioned, the market's really taking a lot of views which are at times contradictory. So if you look at the Federal Reserve, people are very clear from the last reading that the dot chart of whatever plots, whatever they do, clearly suggested a rate hike earlier and larger than earlier forecasted, because that was on the back of a conviction that the US economy is well on the way to recovery, and also inflation then was lower than what it is today. Now, what has happened is when, as I mentioned, in June, I think if I remember rightly, the COVID cases per day were in the 15 or 1,000 per day kind of click. As of last few days, it's gone up substantially, and all the Delta variants are out there. Though, as I mentioned, the fatality is much lower. So the vaccination is giving some comfort. So the market has its own independent view, and only time will tell which is the right view. So what is happening is the market is taking a call that the Delta's presence out there or the COVID's presence out there is going to make sure that the Federal Reserve will not be able to hike interest rates, and therefore the interest rates in the market continue to remain as soft as they indeed are, and is ignoring the 5% inflation marker.
Hmm.
Now, should the win over COVID happen in a very decisive way, and that continues, then you're right. The Federal Reserve will waste no time because they're well behind the chart in terms of where their policy rates are and where the inflation on the roads are. And it is pointless to say these are transitory inflation reads, because they are not transitory inflation reads. These are actually inflation numbers backed by strong upsurge in commodity prices, in metal prices, in raw material prices, and not necessarily demand led, but on the supply side, firm increase in prices. So this is a global dilemma that is happening. You will see in US and the Western world a situation where the liquidity continues to be plentiful because they have not pulled back the monthly purchases of both the treasury bills and the corporate bonds. In the US, that is the biggest factor which will dry up the liquidity.
Hmm.
They did make a little bit of noise in the last federal FOMC that they would look to review those amounts that they buy in the marketplace. They have still not announced a massive, decisive cut. So long as they don't cut the amount of purchases that they do, that much of liquidity is going to come into the marketplace. And as happens in every market, it never enters a real market. It enters the money market and it enters the equity market and keeps the yields low. A situation which is slightly different from what you see in India. Because in India, we are seeing a 9% growth rate. Most people, the worst economists are forecasting a 8.5%, 9% growth rate. So the real economy seems to be growing. Pricing power seems to have come back to corporates. Indian consumer may be buying, even maybe dipping into savings. So it is clearly the savings rates are collapsing in the country. So people are eating out of their savings, which is not bad because they're keeping the economy pumping. So here the catch up is probably going to be faster when the policy rates start, normalizing. But even in India, you need to make sure that in a globalized world, you don't have any of the COVID variants from abroad landing up in India and again toppling us over. So it's a policy dilemma for hiking rates, and that will happen only when the conviction is very strong.
Hmm.
On the other, money markets will always make that call. And in the US, clearly the call is based on the fact that the purchases of GSEC and non-GSEC continues unabated, pumping liquidity into the marketplace. And while the real economy is looking good, the COVID fears are keeping the rates low.
Right. So, Harihar, with this, if you have to look at India itself, how big a task is inflation going to be? Because right now we are at around 6.3% in the month of June. Do you think that this, if the CPI remains above the RBI's target for 6% for a longer time, will they look through it, or do you think if it persists for an extended period of time, that's going to be something that will concern them, where they'll have to somewhere start ignoring the growth aspect? Because right now we're already saying that growth is going to be the major focus area.
See, in India, you're right. The Monetary Policy Committee's primary mandate was inflation, unlike in US, where growth also and employment also is part of the original charter. So in India, obviously, when inflation goes to the kind of numbers, and not just the 6% that you see on the CPI, but the WPI, which is not necessarily the determinant factor for interest rate moves, I think that is obviously worrying for people because, if this was a really transient one, which is oil companies shutting down, all the three oil companies shutting down, and therefore petrol prices on the roads going at 500 rupees a liter, that would be a transient one. But today, globally, inflation is going up, and we are importing in most of those inflation primarily in the metal space and commodity space, and that is reality. But growth has to be a factor because if growth stops, what happens in interest rate is it is not an island. So if growth doesn't happen, or the RBI and the monetary policy don't help the growth or don't help catalyze the growth, what will happen is the GST collections will collapse. So when the GST collections collapse, you will see the government borrowing program again having to go up, and therefore the interest rates will again go up in a spiral without necessarily adding to economic growth. So it is a very different position from the position you see in the USFA. So if consumer-driven industries like real estate and therefore steel and therefore cement and cars, they are very sensitive to interest rates. Now, the primary unit price is anyways something which is out of the control of the monetary policy or the RBI or the government of India because it's determined by metal prices, rubber prices, etc. But should the interest rate be a driving factor, a whole bunch of economic industries take off, and therefore the GST collections go up, as indeed, excepting the last month when we saw the dip below 1 lakh crore, we've seen very substantial and consistent hikes in GST collections over the past few months, which are a great buffer in a year like this when the government expenditure on slightly unbudgeted basis for COVID and for industry relief is going to be there. So I think the patience level with higher inflation in any economy, as we indeed see in the Western economies, and therefore in India, will be higher. And people will be willing to take a chance with inflation, knowing full well that this is not a demand driven inflation surge. It is clearly a statistically measured inflation surge, which is driven by international commodity prices going up and partly a return of pricing power to corporates.
Right. So, with all of this in terms of India, as we're talking about inflation, we've spoken. When do you think the RBI will act with regards to where the interest rate upcycle is concerned? And by when are you expecting a change in stance? Do you think that's something we could expect in calendar year 21?
Okay, I'll first say I mentioned the assumption I'm making and therefore the prediction I'm making. Despite all the noise, I think India has been managing the COVID situation absolutely well. And I think we are not taking enough credit for the kind of speed with which we are vaccinating our population. I mean, it's not an easy task. And therefore, as more and more of India comes back to work and things become more normal, I think the GDP growth is going to be more and more etched in. And I don't look at a number per se as much as the number of different people are giving you the GDP projections. And therefore, I said the range is 8 to 12. So those are powerful numbers. Therefore, they ensure GST collections will look good. So that conviction should probably, another 2-3 months, and if the GST collections and the GDP growth remain where they are, I think Q4 calendar this year is when probably a stance change can be announced, with a small rate hike happening in Q1 calendar 2022, clearly based on a reading that the economy is looking good. At the end of the day, a 25 basis point really hike in interest rates is more a psychological factor than a real factor, because Remember, if oil prices went up from 100 to 107, it's a 7% hike in oil prices. We don't see the economy collapsing as a result of that. Car sales are still 2.5 lakhs per month. But it is it's a sensitive factor because a lot of decisions are taken by people based on the interest rates rather than the unit prices. So this year, last quarter, as well as next year, first quarter is when the change in stance followed by a policy rate hike could happen. And already the money markets, if you look at what is called the overnight index swap, they're all factoring in a rate hike in the coming few months. So that is why you're seeing some of the government auctions also consistently devolving on primary dealers, because people are believing, especially the medium and long-term papers, might cause you damage if you bought them at the current yields, because if a rate hike were to happen in the next 6 months, then the paper you bought at a current yield will probably be traded at a much higher yield and could cause you mark-to-market losses. So that's why even Friday last, you did see 11,000 crore plus devolvement on primary dealers. So it will happen. It's a question of more conviction that the GDP growth rate is not ephemeral, but it's consistent. It's going to last.
Right. So with this, another factor, that we're considering with the GDP as well as to how India's debt picture is panning out. How is, how is the current account deficit and the fiscal deficit holding up as well? So taking these two data points, Harihar, now India's debt to GDP ratio is now almost at a 14-year high right now. Secondly, if you see in terms of the current account deficit, 1% of GDP is what it was at in terms of where the March quarter goes. What's the kind of impact we could see of both these factors from here on? And what's your assumption as to what's your anticipation?
See, clearly, globally, virtually every country's ratios have gone for a toss, because people have kept that thought to one side and said, let's first rescue the country. Let's put it back on an even keel, and then we'll figure out the health, the economic health. So the rating agencies have obviously developed a kind of more, shall we say, lenient view, because this is a global issue. So that's number one. Number two, for us, I think most of the rating agencies have reaffirmed our rating at this point in time. I'm also seeing the buoyant stock market and the kind of huge appetite that's coming up for IPOs, probably giving for the first time the kind of muscle power that you need in the background for large issues like a LIC or a oil company disinvestment, things like that to happen. So for the first time, I can see a 1-2 trillion rupees disinvestment target may not necessarily be out of question. And if you add some of the SUU, ITI investments like the L&Ts and the Axis Banks, etc., added to the LIC, you can actually have a decent amount of buffer coming in for the government in terms of further disinvestment. So I don't think that is a real issue at this point in time, provided we have a way out. And the way out for India, and that is where we stand out in the world, is our economic growth. We are now already showing a powerful growth, because GST collection of 1.1 lakh to 1.2 lakh crore is on the base of hardcore sales to customers, not as the excise duty collections which is moving from factory gate to a sales shop. So the GST collection, and that too in a COVID affected country with probably half the guys working from home. So I think we could be in a very good space where if we can ride out the storm and we get the economy back to the 9-10% growth rate, then the GST collection will be so powerful we can take care of the debt in that sense. And the current account deficit, as I mentioned, it's a combination of various things. So we've been lucky, as I mentioned earlier, that while the oil prices went up and could have hurt us really badly, we were saved by the fact that we used lesser fuel. So we didn't buy as much of fuel, and therefore the rupee managed to only drop a little bit. Similarly, if the FPIs backed off, the FPIs have taken off in so big a way, whether it's because of the unicorns or whether it's because of the the IPO rally, whatever the reasons could be anything. But we've seen decent amount of inflows. Where I remember we used to have $40 billion annual FDI. In just one quarter, we've had $20 billion in the first quarter of this year, and we have visibility that there's going to be many others happening. So I think on the rupee front, I'm really not bothered. And that is probably the reason why even with $600+ billion with the Reserve Bank of India, they're not panicking about it. Because these, if you're an exporter actually in this country and you see forward premiums at 4.5%, which is almost 3 rupees, and you see a spot of 74.40, you actually have to be going to your board and saying that, listen, I can sell 1 year forward at 77, 78 rupees to a dollar, which is too lovely a level compared to the economic fundamentals as projected. There is a projection, there is an assumption here, let's face it. So exporters should come in to kind of make sure that the rupee doesn't fall below a particular level. And the exports right now, export market looks fine enough. So I'm not too bothered about the current account deficit. And as I mentioned, the debt to GDP ratio at this point in time, I'm not bothered because it's excused globally. And we do have a way out in terms of GST collections in the main. And secondly, disinvestments.
Right. So what's the journey that the bond markets could take from here on if you have to look at calendar year 21? And what's the range we should be looking at?
Bond markets is probably going to be the most challenging market. It actually has been a challenging market for the last 6 months because obviously you have interest rates which are below both the CPI and the WPI. So when you have that kind of a situation and you're a bond dealer, you know that at some stage the bond yields are going to correct and you're going to be faced with mark-to-market losses. So as I mentioned earlier, the development are a sign of that. So if you're a bond trader, you would firstly try to reduce your duration as much as possible, move to as short-term a possible position as possible, and make sure that your MTM risks are low. Do we see yields going up? They've already gone up, but there is good space for the benchmark 10-year to go up. We already saw the new 10-year paper, which was issued just a couple of weeks back, already coming to the level of the old 10-year in the last few weeks, and it's trading at the cutoff was at 6.15. So could it go to 6.25354 level? Yeah, it can go to the 6.25 to 640 level. And it won't be a train smash either, both for the government finances. But I think where the RBI is probably trying to gradualize the whole thing is more than the government borrowing, it's a corporate sector borrowing. It's more the retail sector borrowing. So this becomes a benchmark for all of them. So as I mentioned, it's more a calibration issue to make sure that the growth, which is there in the economy, more not powerful, but there, doesn't get stalled by any dramatic hike in interest rates. And meanwhile, also some of the transient factors in the inflation model, if they start coming off with a good monsoon, for instance, the agricultural product prices, the protein related product prices, if they start coming off, I think that will provide some relief from the inflation side. And yields will definitely go up. And as I mentioned, you will see adjustment happening, but probably it's going to be more firmly in the first quarter of next calendar.
Okay. And overall, in the short term, if you have to take a 3 to 5 month perspective, what's the kind of range you would be holding on with regards to the rupee, taking into consideration how the bond markets move as well?
See, it's interesting. In the bond market, if you take just the 2 year spot, I think that's a rich enough place. So if you want to play in the bond market, the 2.5 year range is almost in the touching 5%. So that is probably discounting in the worst of hikes. You could probably go and hide there. And away from the 10-year, because even if the 10-year goes up by 25 basis point, you'll actually get hit by almost 2% in terms of mark to market. So you stay away from the longer terms, go into the shorter term. In the shorter term, the super short term, the 1 year is not very rich. So you could get a yield pickup of about 70 odd basis point by moving to the 2 year bucket. In terms of the dollar rupee, do I see 75 on the cards? Maybe yes. But if I ever see 75, I would rather short the dollar at that stage and go long rupees. Because I think the fundamentals are defying that kind of a weakness, especially given the visibility of too many IPOs happening, too many overseas investment, the kind of oversubscription that you're seeing shows you the continuing appetite that these kind of issues are going to have. So I would say probably 74, 75, 75 can happen, but those will be sell levels for if you're an exporter.
Right. And very lastly, Harihar, with regards to where the RBI goes, now clearly, they have been able to create conducive financial conditions as well right now. So far, they've undertaken regular OMOs. They've injected additional liquidity as well, in addition to GSAP 1.0. With all of this, do you think these measures that the RBI has taken will be enough to keep yields in check, or do you think they will have to do something more?
I think you did mention that the RBI has done a really commendable job in not just keeping yields in check, but to make sure that money gets given to the areas that it has to go to. I think that actually is a bigger objective in the whole process to get the GDP up. So many of those targeted repos that they came out with, that if you go to them and borrow money, and if you lend it to the NBFC sector, if you lend it to the SME sector, and not just the GSAP, but even those guarantee schemes that they came with, You could just lend out to the schemes and get a guarantee, or you could borrow money on the repo window long term at repo and then give it to the sectors. I think they've done an exemplary job. And I think if you look at the macro picture, what they're trying to do is clearly what we've been talking through this meeting, which is that they're trying to get the GDP up across the board and not just in those 50 Sensex stocks, but across the board, so that the GDP growth is more sustained, more real, more consistent. In which case, the GST collections take care of all the government borrowing program. And at that time, even if they let go a 25 basis point, hike, it will be received by the market in a much more comfortable way. Because if I were the governor, you would ideally like to say that we are hiking policy rates, but the GST collections are looking very good. We are cutting government borrowing program by 25,000 crores. Now that luxury you can only have when you see the GDP looking strong and the GST collections looking strong. Are we on the visibility of that kind of a path? Clearly, I can see that there. Can we predict that it's going to happen 100% sure? Well, you need to figure out this COVID variants. And today I saw in UK, there is an absolutely new variant which has come. So I think it is choppy waters, but in India, so far, I think we managed very well. And I would like to believe that I think there is clear probability. Conviction is a tough word. Probability that we will ride out the storm. And even if a rate hike happens, which probably will be overdue by next year, the market would have already got sensitized to the whole thing. And in the real markets, interest rates don't wait for policy rates to go up. In the real market, the rates have already started going up, and the GSEC yields have actually gone up to reflect a possible yield hike. So when the yield hike actually happens, you may not get one more hike in the real market rates, because they will say, yeah, we knew it. We've discounted that.
Absolutely. I think for everything that we're looking at right now, there is a caveat with regards to how COVID pans out, because a lot of actions and reactions will depend on that as well. Thank you, Harihar, so much for joining us on the show. Always a pleasure to speak to you and get great insights. Thank you. Stay safe and speak to you soon again.
My pleasure too. Thank you.
Subscribe to our YouTube channel for in-depth interviews of India Inc. and press the bell icon so that you do not miss our updates.